Have you ever felt just utterly overwhelmed by the sheer volume of financial information out there, trying to figure out which experts to trust or, how to truly understand what you're actually investing in? Well, today we're going to try and cut through some of that noise. Welcome to the Deep Dive, where we take complex material and extract the most important insights, giving you a shortcut to being truly well-informed.
And our mission for you, the listener, is to pull out those practical nuggets of knowledge from each chapter, really, and its vivid examples within Joel Tillinghast's incredibly insightful book, Big Money Think Small. And this isn't just about finance, is it? It's really about decision-making, understanding human behavior, and the surprising clarity that you can actually find in simplicity.
That's exactly right. Today we're embarking on a fascinating deep dive into excerpts from this book. We'll explore how Joel Tillinghast, a truly legendary investor, approaches the market. We want to help you understand how to approach investing with a clearer, more informed mindset, hopefully avoiding those common pitfalls and spotting genuine opportunities. And we'll be guided through this material by our expert here, who has a real knack for connecting the dots and explaining not just what happened, but why it truly matters for your understanding. So let's unpack this. Okay, let's start by looking at Joel Tillinghast himself, the investor behind this book. He's highlighted right from the foreword. The source material paints this picture of just incredible analytical ability, but also a customer-first mindset. Apparently, it impressed someone enough to talk to him for over an hour after just a cold call way back in 1986. And the author even describes Joel as one of the greatest, most successful stock pickers of all time, arguing that if you looked up alpha, that measure of beating the market in the dictionary, there should be a picture of Joel right there. So what qualities really defined his unique success? What made him different?
Well, it's striking, isn't it, how much his core identity as an investor seems to boil down to these fundamental human traits rather than just, say, technical wizardry. The book really emphasizes that there's no precise recipe for replicating his success. Why? Because he's truly one of a kind. But, and this is key, you absolutely can embody the qualities he brought to the table. We're told he's incredibly patient, open-minded and flexible. He also seems to possess this rare ability to just ignore the daily worries of the world, allowing his investments the time they need to succeed. And crucially, he's willing to do deep, independent research. But he's equally willing to admit when he is wrong and get out of a position. He's persistent, yes, but importantly not stubborn. That combination, persistence and flexibility, is incredibly rare and powerful in investing.
That blend, persistence and adaptability, it seems absolutely key. The book mentions some of his early successes, right? Detailing how he impressed the author with ideas like Puerto Rican cement and a savings and loan company that was completely off the author's radar. And then quickly followed by discussions about Chrysler and Armstrong Rubber. It feels like these early wins really set the stage for his later consistent approach.
Indeed, they did. And this ties directly into his consistent ability to find those long-term growth stocks before their big run-ups. The book points out, quite painfully sometimes, that the ones you miss on the way up are often the ones that hurt the most financially and emotionally. It highlights names like Ross Stores, AutoZone, Monster Beverage, Ansys, all big contributors to the Fidelity low-price stock fund. The common tendency for most investors, as the book notes, is to cash out after a modest 10 or 15% gain. Just take the profit and run. But Joel understood that doesn't mean there isn't significantly more growth ahead, maybe much more. So a truly successful investor, then, is one who holds for the long term, but is constantly monitoring the fundamental story. That story remains intact, you stay put. If it changes, if it breaks down, you move on. This really underscores why patience is so vital. It allows the fundamental story to play out fully, rather than, cutting off gains prematurely because of short-term thinking or market noise.
And a fantastic example of that monitoring and adaptability is Monster Beverage. He held it for a significant period. Originally, he was interested in it for its natural fruit drinks. That was its initial core business. But the actual gains, the really explosive growth that moved the needle, came from the phenomenal success of its energy drink line. A completely different driver. That's such a powerful illustration of how the reason for holding a stock can evolve, right? And how an investor needs to be attuned to that shift in the fundamental business story. It's not about being stubbornly right about your initial premise, your first idea, but adapting to new information and recognizing when a company finds an even better path to growth. Okay, so with Joel's unique approach in mind, let's zoom out a bit to the very heart of investing itself. The book section, How to Think About Investing, opens with this powerful truth. At its core, investing is all about making decisions, often in a world filled with unknowns. It described investing as having this hall of mirrors quality because we're constantly assessing the decisions of others, looking into an unknown future where the facts aren't always available. So what's the best approach given this inherent uncertainty, where opinions can be just dramatically wrong?
Right. Given this fundamental uncertainty, where information is often missing, sometimes, frankly, unobtainable, the book encourages us as individuals to make decisions mindfully. It talks about using System 2 thinking. That's the slow, deliberate, analytical thinking, as opposed to System 1, which is fast, intuitive reactions. The goal's pretty simple, really. Make fewer choices, but make sure they're better choices. Practically speaking, this means avoiding excessive turnover in your portfolio. Stop the constant churning. And focus your analysis on the core question, what's this business actually worth, rather than just chasing what happens next in the market. It also means choosing an investment format that truly works for you, whether that's picking individual stocks, maybe opting for broad index funds, or using actively managed funds. And it really makes you wonder, doesn't it? How often do you, the listener, truly slow down enough to apply that System 2 thinking to your investment decisions, especially when emotions like fear or greed are running high?
That's a perfect lead-in to a classic historical example, one that really illustrates what happens when you don't think slowly and rationally. The South Sea Bubble. The book directly links the categories of mistakes made during this infamous event to the opposite of its own key tenets. It's almost like a perfect cautionary tale. Can you walk us through those mistakes and how they relate back to the core principles of sound investing?
Absolutely. The South Sea Bubble offers just a fantastic, albeit painful, case study. And the lessons are truly timeless. It highlights a few key behavioral pitfalls. First, there was this fundamental lack of rationality, just completely detached from reality. People invested based on what the book calls a shared hallucination about cities of gold in South America. They ignored the clear fact that while commerce with English-speaking North America had been lucrative, South America was largely Spanish territory, and the facts about potential riches just couldn't be readily ascertained. It was pure speculation. Second, there was an undue reliance on authority. The king's share ownership was seen as this massive endorsement, leading people to fall blindly without doing their own homework. And third, the powerful force of fear of missing out, FOMO, really took hold. The book says this sounds laughable until you've witnessed people around you pocketing unearned windfalls. It's hard to resist. Even Sir Isaac Newton, celebrated for his rationality, reportedly lost a fortune and famously lamented, "I can calculate the motions of the heavenly bodies, but not the madness of the people." That really highlights how powerful FOMO can be, even for the most brilliant minds, pulling them into collective irrationality. If we connect this to the bigger picture, the South Sea Bubble just proves how timeless these behavioral pitfalls are. They repeat themselves in various forms throughout financial history.
It's such a sobering reminder that human nature, especially under the sway of greed and fear, really hasn't changed much over centuries. And it brings to mind another bias the book addresses, hindsight bias. That tendency to believe an outcome was predictable all along, even when the necessary information wasn't available when the decision was made. How do we actually fight that tendency? How do we get an honest look at our past decisions without rewriting history?
Well, the author personally combats hindsight bias by keeping detailed company files and intermittently noting his reasons for trades. It's sort of an investment diary. Another technique he suggests is the premortem. This is a really powerful technique. You mentally time travel to a future point, assume a decision you made today turned out badly, disastrously even, and then you brainstorm the reasons for the flop before it actually happens. This forces you to anticipate potential failures and their underlying causes. It's proactive risk management. And what's fascinating here is how often, when you refer back to those original notes, you find the initial reason for buying was maybe replaced by a new one, sometimes even a stronger one. Or perhaps a clear sell signal truly did emerge, but you ignored it at the time. The Monster beverage example we discussed earlier illustrates this perfectly right. The original interest was fruit drinks. The big gains came from energy drinks. The thesis evolved, and he adapted. It highlights the need to adjust your thinking based on new facts, not just revise history to make yourself look smart after the fact.
That practice of documenting your reasoning, maybe doing a premortem, it seems incredibly valuable for honest self-assessment. But there's another behavioral pitfall the book highlights, being highly overconfident. It points out that investment institutions are just rife with overconfidence, and Wall Street naturally attracts alpha males, or as the book colorfully puts it, people born on third base who think they've hit a triple. It also mentions that being cocksure helps careers in finance. So what are the specific dangers of this pervasive overconfidence in the world of investing? It seems like a double-edged sword.
It absolutely is. Overconfidence, while it might help careers by attracting clients, clients often flock to a coherent story told confidently, can be profoundly dangerous and feels like investing. Why? Because true ability is so hard to measure due to constant noise and streakiness in market returns. Luck plays a huge role. The book suggests that some of those triumphant, bold risk takers might simply have been lucky they caught a good wave. And the most expensive emotions, as the book highlights, are seeking comfort and panic. They're two sides of the same coin. These lead directly to unplanned purchases and sales, often at the worst possible times. It's that devastating cycle. Oh crap, how could I lose half my money in a conservative stock? I must destroy the evidence now. Which is then followed by the self-reinforcing thought, see, I was right to panic, I got out just in time, and I can't possibly go back in now. In contrast, value investors like Tillinghast accept worry as part of the process. They worry especially when things aren't going wrong, because the emotional cost is actually lower when the facts eventually prove them right. Their anchor is valuation, not emotion. It encourages critical thinking. Are you reacting to market madness, the whims of the crowd, or are your investment decisions grounded in reality and a careful assessment of value?
Okay, so beyond understanding our own decision-making biases, the book then delves into investment blind spots in part 2. These can range from tiny details like how your advisor is paid to exotic securities you don't understand, or even, as the book puts it, cosmic questions about cross-cultural misunderstandings in global investing. What's the core message here about identifying and navigating these blind spots that can otherwise trip up even experienced investors?
The core message is remarkably direct, actually. It says you must study your own strengths and limitations. Know thyself, basically. And crucially, you must also study the strengths, limitations, and importantly, the incentives of the agents to whom you entrust your capital, your advisors, your fund managers. This is paramount because these blind spots, if they remain unaddressed, directly influence your success and can lead to really significant losses or underperformance. It emphasizes personal responsibility. You have to understand the mechanics and incentives of investing, not just passively accept the story you're being told.
And a powerful illustration of how these blind spots manifest is in the section on costs and incentives, specifically through that story of Fred and his financial advisor. Fred seemed to be focused entirely on what the advisor could do for his finances. What did Fred miss in this equation, and what was the quantifiable impact of that oversight? It was pretty stark, wasn't it?
Oh, it was incredibly stark. Fred missed a fundamental truth. While he was focused on what his advisor could do for his finances, it just didn't occur to him that his advisor was probably focused on what Fred could do for his advisor's finances. The book makes it crystal clear. Investors' costs are always someone else's incentives. Always. Fred's advisor's firm charged both a fee based on the account's value and commissions on trades, and a portion of those commissions went directly to the advisor. So the more trading, the more money the advisor made, regardless of whether it helped Fred. And sure enough, Fred was found to be totally swapping his holdings every 8 months, constant churning. And those fees and commissions were just eating significantly into his returns over time. The book provides this really eye-opening comparison that seemingly small annual fee plus the trading costs can have an astonishing impact over the long haul. The numbers are really stark. By minimizing those costs and avoiding unnecessary trading, an initial $1,000 investment could grow nearly twice as much over 3 decades. It's just a powerful argument for sometimes simply doing nothing when it comes to chasing quick gains, and maybe choosing a seemingly slothful manager with moderate fees who focuses on the long term.
That's an astonishing difference in potential wealth, just from understanding incentives and costs. Another insidious type of blind spot the book discusses is data without understanding. This seems particularly relevant today with the rise of trends like factor investing or smart beta, constructing portfolios based on attributes like market cap or momentum. How can having abundant data but without true comprehension be dangerous for investors? And what specific example does the book use to hammer this point home?
Well, factor investing sounds very sophisticated, doesn't it? And yes, attributes like small caps or low volatility have historically outperformed, on average. But the profound danger lies in not truly understanding what you're investing in, even with reams of data available. Data isn't knowledge. The book uses the, frankly, chilling example of the TVX ETN. That's the Velocity Shares 2X Long VIX short-term exchange notes. Fred, the investor from our previous example, was apparently baffled by its purchase in his account, and rightly so. This derivative was based on the VIX, often called Wall Street's fear gauge, which essentially tracks market volatility expectations. The book pulls no punches here. Volatility itself is just a measure of market jitters. It has no intrinsic underlying value, zero. It's fundamentally unanalyzable for long-term investing. And to make matters worse, TVX was levered 2x leverage and acted like a wasting asset, meaning its value decayed over time due to its structure. Wall Street, the book notes quite cynically, invents these financial contraptions that are too complicated for many buyers to evaluate properly. And the issuers are not duty-bound to act in your best interest like, say, corporate executives are supposed to. Knowledgeable participants profit precisely from the ill-advised trades offered by those who do not understand. It's a setup for exploitation. So it forces you to ask, when you encounter a complex financial product, do you truly understand every underlying detail and mechanism, or are you operating on a story without the numbers? Are you potentially the unwary victim?
So what's the big takeaway for us, the listener, from all these investment blind spots? How can we ensure we don't fall victim to them, especially given the complexity often seen in financial products and the advice landscape?
Well, the purpose of exploring these blind spots, like Fred's experiences, is really to sensitize you to situations where you might ignore crucial details and inadvertently assume untruths. It's about building awareness. While your specific blind spots might differ from Fred's, there's common ground in how they manifest, often through complexity, misaligned incentives, or a lack of true understanding. If we don't clearly know our own financial goals, nobody else is going to prioritize them for us, that's for sure. And many people, unfortunately, maybe don't want to ask the critical questions about how and why specific strategies work. They just want the answer. Aspects like costs, incentives, who to trust, effective risk control. They might seem like distracting details from the main task of maximizing returns. But the book argues they are, in fact, absolutely central to it. You can't maximize returns if costs are eating them away or if you blow up. The best investment risks are those you are fully aware of, that you can analyze thoroughly, and that genuinely offer favorable odds, calculated risks. Unless you've taken the time to understand the intricate details, complexity is always your enemy. Always. Diversification, in this context, becomes a vital protection against those risks you're unaware of and simply can't analyze. The unknown unknowns. And finally, anything that interferes with your ability to maintain a long-term view, like excessive financial leverage, margin debt, should be rigorously avoided. It's really about building a robust defensive strategy that allows your well-chosen investments the time and space they need to flourish.
Moving on, Chapter 6, titled It's the Simple Life for Me, opens with a great quote from Isaac Asimov. People who think they know everything are a great annoyance to those of us who do. Love that. This chapter dives into a core tenet of sound investing. Only invest in businesses you understand and know well. Keep it simple. But what does understand truly mean in this context? It has to be more than just, recognizing the brand name, right?
Oh, absolutely. To truly understand a business, the book lays out very definite and quite rigorous criteria. It's not a casual understanding. You need to grasp precisely what every segment of that business does and, crucially, how each segment actually makes money. Follow the cash. You must be able to identify the key factors that will produce its future earnings, and you need to be able to make a more or less accurate, reasonable stab at forecasting them. Not predicting, but forecasting based on drivers. It's also acknowledged that not all industries are equally easy to understand. Biotech, for instance, is deemed impossible for most lay people because of its inherent scientific complexities and regulatory hurdles. It requires specialized knowledge. And after a little study, you'll also quickly find that some industries are just brutally competitive, consistently unprofitable for almost everyone involved. Think airlines, maybe. While others are consistently lucrative, perhaps due to moats or regulation, this really encourages critical thinking. What industries are genuinely within your personal circle of competence? And which ones are beyond your grasp, requiring you to either learn substantially more or just simply avoid them altogether? Be honest with yourself.
That makes sense. It implies a really deep level of engagement with the business itself, not just the stock ticker. But isn't familiarity sometimes a trap? We often invest in companies we know as consumers. The book suggests that familiarity can actually work against investors in surprising ways. How so?
It absolutely can be a trap, a dangerous one. The source highlights this fascinating and counterintuitive point. If you had continuously invested in only the single largest S&P 500 stock by market value, think IBM, GE, ExxonMobil, over the years between 1972 and 2016, your compounded returns would have been less than 4% annually. Meanwhile, the broader index earned over 10%. Why? Because companies with large market values are often widely known, widely followed, and they feel safer. They're comfortable. The book uses the example of Facebook, whose market value dramatically exceeded Walmart's back in 2016, despite having less than 1/20th of Walmart's revenues at the time. Why the disparity? Perhaps precisely because Facebook felt so familiar and ubiquitous, everyone used it. This familiarity or sheer size gets reflected in things like lower bond yields and higher PE ratios for popular large companies, which means you're often paying a premium for that perceived safety and comfort. So it raises an important question. Are you investing based on superficial familiarity and comfort, or on a deep, dispassionate understanding of the underlying business fundamentals and, crucially, its valuation?
So how do you define know and understand for a potential investment in a way that avoids that familiarity trap? The book provides a very specific, almost like a checklist, of questions investors should ask themselves.
Yes. The author lists these crucial questions that form a really profound checklist for any potential investment. They force you to go way beyond surface-level knowledge. First, do I understand why customers buy the company's product? And, just as importantly, why might they stop buying it or switch to a competitor? Second, what specifically makes this company better than its competition? Is it sustainable? Third, how does this business make its money? What are the profit drivers? And why does its profitability rise and fall? Is it cyclical? Fourth, what drives its growth? Is it market growth, market share gains, new products? Fifth, how does this sort of business typically fail? What are the common pitfalls in this industry? Sixth, do I know with some reasonable confidence where the company will be in 5 years? And what are the key factors determining that outcome? And finally, can I spot a great opportunity in this industry? Is this an area where I'm likely to make wise decisions given my knowledge and temperament? It's a really robust framework, guiding you towards truly knowing a business before you commit your hard-earned capital.
These questions provide a really robust framework, pushing for genuine understanding. Can you give us an example from the book of an industry that was clearly beyond the author's understanding and what that taught him about the importance of staying within one's circle of competence?
Yeah, the example of Dendrion's incredibly unpredictable journey is very telling. It's a great lesson in humility for any investor. Unprofitable biotech stocks, the author readily admits, have always been way beyond him, just too complex, too uncertain. Despite trying to learn from doctors socially, maybe picking their brains at dinner parties, he never bought Dendrion stock. He listened when a medically trained psychiatrist friend, Dr. Rubin, got really excited about Dendrion developing Prevenge, an immunotherapy for prostate cancer, back when its stock was just $4. The author shared the fascination with the new treatment. Who wouldn't? But he didn't buy the stock precisely because he knew he couldn't handicap FDA approvals or reliably estimate future earnings. It was outside his competence. He notes that not even a superhuman securities analyst could have foretold Dendrion's extreme ups and downs. If they had had perfect foresight, they would have concluded its ultimate value was zero, which for many years would have seemed absolutely ridiculously wrong as the stock soared. But the company eventually collapsed into bankruptcy. This just highlights the critical importance of staying within your circle of competence and, maybe more importantly, recognizing when a business, no matter how exciting the story sounds, is simply too unpredictable for your analysis to be reliable. It's a powerful argument for knowing what you don't know and having the discipline to walk away.
That seems like a very wise self-assessment, knowing your limits. What about an industry that is seemingly boring, but perhaps more within one's competence, like insurance? Even in these apparently simple industries, there can be hidden complexities or ways companies stray from their core competence, right?
Well, absolutely. Life insurance is presented as an industry that can seem boringly predictable, but it offers a clear path to understanding if you stick to the basics. It works on the principle of aggregating large numbers of similar, uncorrelated risks, where outcomes tend to average out to a theoretical mean over large populations. Law of large numbers, basically. Think of a typical life insurance company. Their actuaries, those number-crunching wizards, can reliably predict within a narrow range how many policyholders will pass away each year out of a large group. This allows a conservative life insurer to operate on a highly predictable model, collect premiums, manage expenses carefully, invest conservatively, and pay out benefits as predicted. It's a business based on aggregating large, predictable risks, making it generally quite stable and understandable. You could reasonably project a conservative life insurer's future. But as the book notes, the forecast is often pretty drab. It's a minimal growth market, usually. Profits won't be awful because everyone uses similar mortality tables and cost structures, but they also won't be thrilling due to intense price competition.
The critical insight for annuities and other income policies is matching the cash flows from their bond portfolios with the required payments to annuitants. You have to stick to top-quality bonds because annuitants are typically very risk-averse. However, human behavior, unlike mortality statistics, is shifting and unpredictable, and insurers are sometimes tempted by junk bonds or mismatched maturities to chase higher interest rates. And that introduces significant, often hidden, risk.
And that's precisely where even a seemingly simple, predictable industry like insurance can go dramatically wrong, as we saw so starkly with AIG during the global financial crisis. It demonstrates how a lack of competence or deliberately straying outside of it can lead to absolute catastrophe.
Yes, exactly. AIG, a company rooted in traditional insurance, famously strayed way beyond its core competence by insuring incredibly risky credits through derivatives called credit default swaps, or CDS. This effectively resulted in huge concentrations of investment risk that all went bad simultaneously when the housing market collapsed. It wasn't diversified risk, it was highly correlated risk. As the CDS liabilities surged, AIG had to post more and more collateral, straining its liquidity to the breaking point. To stop the bleeding, AIG started closing out some swaps at the worst possible times, turning losses that might have been temporary on paper into massive permanent cash losses. Its stock crashed, obviously, and the U.S. government had to step in with a massive bailout to prevent a systemic collapse. The author actually admits he himself had strayed beyond my competence and was in over my head regarding CDS initially. He considered only the brief recent history of these instruments and didn't conceive of a broader analogy, like taking on huge correlated catastrophic risk for what turned out to be minimal premiums. The key takeaway here is that while investing in simple businesses often means that if outsiders can diagnose issues, skilled managers usually know how to fix them. But in AIG's case, it suggests their management might have been in over their heads too, chasing complexity and profits they didn't truly understand. It demonstrates that even a simple business can be derailed if management gets too ambitious or strays too far from its knitting.
Okay, let's shift gears slightly. Chapter 7, Thinking Small, starts by questioning the utility of macroeconomics for investors. You know, things like GDP forecasts, inflation predictions, interest rate moves. Despite GDP obviously reflecting business sales and earnings, why does the book argue that macroeconomics is shockingly ineffective in predicting the stock market, especially when so much media attention is lavished on it?
Well, what's fascinating here, and maybe counterintuitive for some, is that while gross domestic product GDP does generally indicate the overall direction of business sales and earnings, the book argues the links are actually pretty weak, they're dynamic, constantly changing, and often very poorly understood. All the new economic data that gets released daily tends to shorten investors' horizons, right? It leads to these short-term, knee-jerk reactions rather than fostering long-term understanding. And maybe more critically, economic data reports the past, sometimes with significant lags, while stock prices reflect future expectations. There's a fundamental mismatch in timing. The chain of intermittent, often weak connections between macro data, specific companies, and ultimately stock prices makes it incredibly hard to spot where your macro forecast went wrong, or even to know that an error occurred until much later, if ever. Most economic forecasts, the book points out, are really meant to suggest broad stock price trends, but they rarely pause to estimate the actual fair value of the market or specific stocks based on that data.
So it encourages you, the investor, to focus on what you can control and understand at a more granular fundamental level, the specific business, rather than trying to time the market based on broad, often unreliable economic trends.
So if these big questions and macro forecasts are generally unreliable for making direct investment decisions, what kind of economic understanding is actually useful for investors? Does the book dismiss economics entirely?
No, not entirely, but it reframes its usefulness. The book states that everything in economics and investing is tendencies, probabilities, and situations. Nothing is everywhere and always. There are no iron laws like in physics. Economic events, it argues, are these long, complex chains of events and probabilities, feedback loops. It's messy. The only way to meaningfully follow that chain is to be as accurate and precise as possible in describing reality and, crucially, start with realistic assumptions about human behavior and incentives. And here's a key insight. Economic theories describing simple actions and transactions like supply and demand for a specific product are usually more reliable than those attempting to describe vast, complex, interconnected systems like the global economy. Keep it simple where possible. Even robust theories, the book reminds us, have counterexamples. Nothing works all the time. So this makes you wonder, how much time do you spend trying to decipher complex macro forecasts versus, say, understanding the specific competitive dynamics and the balance sheet strength of the companies or industries you're considering investing in? The book strongly suggests your time is better spent on the latter, where real, actionable insight is more likely to be found.
The author's personal experience working at Drexel Burnham Lambert back in the 1980s perfectly illustrates this point about the limited utility of macro forecasting for direct investing. What did he learn there about the whole game of trying to nail the economic number or predict market reactions?
Yeah, his experience at Drexel was quite illuminating and maybe a bit disillusioning. He found the clients had basically no use for elaborate economic models or deep theories.
They simply wanted the number, the GDP forecast, the inflation print right before a key economic statistic was reported. Or, failing that, they wanted immediate explanations for what had just happened and what it meant for the market, like right now. Traders played the statistics for the next month or quarter. It's a short-term game. And nailing the number was, and probably still is, a favorite pastime on trading desks. His boss at the time wisely advised him never to give both a number and a date in a forecast. Good advice. Eventually, one particularly insightful client stopped reading his daily comments entirely. The client explained that while the forecasts were accurate enough, they were just copycats of everyone else's consensus view. They offered no edge. What the client really cared about was the size of the market reaction, not the data itself. Would the market shrug it off or panic? A correct prediction, the client explained, also had to be important and, crucially, unexpected. It had to be non-consensus to be valuable. This just highlights the immense challenge of gaining a genuine, repeatable edge in macro forecasting. If everyone knows it or expects it, it's almost certainly already priced into the market.
That sounds like a recipe for constant frustration, trying to be right, important, and unexpected all the time. He shares a personal anecdote about attempting to trade on economic data himself and losing $40,000, which apparently exceeded his annual pay at the time in under a month. Ouch. What did that painful experience teach him about stock market timing systems versus the approach of valuing a business?
Oh yeah, that experience was a very rude, very expensive awakening for him. He had dabbled in stock index futures trying to connect the dots. Economic statistics linked to interest rates linked to stock indexes, and ultimately stock indexes linked to specific stocks and trading profits. Despite figuring out some connections between different economic statistics, he admitted he simply could not connect economic data, interest rates, the stock market, and ultimately trading profits in a way that consistently made money. It was too complex, too noisy. Losing money was his only clue that something was fundamentally amiss with the approach. Painful feedback. And this contrasts so sharply with an intrinsic value approach, right? If he believed a stock was worth $50 and he bought it at $40, he'd actually be more enthusiastic if it slipped to $35, assuming the underlying value hadn't changed. It's on sale. Unless new information had genuinely reduced his fair value estimate to, say, $30, in which case he'd sell because the facts changed. Momentum investors, by contrast, might buy at $40, sell at $35 when it dips, stop loss, then maybe buy back at $41 if it pops back up. It's purely price-driven. His painful experience really drove home a crucial distinction. Valuing a business based on its fundamentals provides a clear anchor, a guide for action and assessment, whereas speculating on price movements driven by economic data or crowd psychology is often just a blind gamble where the only feedback is the immediate profit or loss, with no underlying logic.
And even legendary figures struggled with trying to time markets based on macroeconomics. What about John Maynard Keynes? I mean, a giant in the field of macroeconomics. What was his experience with investing using his own theories?
It's a fascinating story. Keynes, arguably the most influential macroeconomist ever, famously managed the chest endowment funds for King's College at Cambridge. For several years in the beginning, he used his deep economic and monetary analysis for top-down asset allocation and sector rotation, essentially a sophisticated market timing or momentum style. However, cumulatively, his results during the 1920s actually lagged the overall British market. He later admitted, quite frankly, we have not proved able to take much advantage of a general systematic movement out of and into ordinary shares as a whole at different phases of the trade cycle. He could make it work consistently. He also observed that it needs phenomenal skill to make much out of it. Understatement, perhaps. Even more strikingly, the 1929 crash and the subsequent Great Depression caught Keynes completely by surprise. He personally lost about 4/5 of his net worth, partly because, interestingly, he never stopped using borrowed money, leverage in his personal investing.
So if the greatest macroeconomist ever couldn't consistently trade successfully based on credit cycles and business cycles, it really raises a significant question for you, the listener, about the practicality and efficacy of such strategies for the average investor. Maybe focus elsewhere.
That definitely puts it in perspective. And this relates directly to the efficient market hypothesis, or EMH. How does the book interpret the relevance of EMH to economic data specifically? And what does that imply for investors trying to profit from widely available macro information?
Right, the efficient market hypothesis. The basic idea is that market prices reflect all available information. The book suggests that for statistics and trends universally important enough to be reported on TV, or the internet, think GDP, inflation, unemployment, this semi-strong form of EMH seems like a pretty fair description, that the information is out there and markets react quickly. The strong form of EMH states that even private or insider information is reflected in prices. The author finds this clearly incorrect for individual stocks, citing plenty of news reports about large profits made from illegal inside information. However, interestingly, for economic data, the relative lack of major insider trading scandals, despite the massive potential profits you could make if you knew key data points in advance, hints at the strong form of EMH might actually apply more closely here. This suggests that most big-picture economic information is either widely known, widely anticipated, or perhaps just not consistently actionable enough for insiders to reliably profit from it, or maybe the risks are too high. The implication for you, the investor, is pretty clear. Trying to trade based on readily available, widely reported economic data is highly unlikely to yield consistent alpha or superior returns, simply because everyone else already has that information too. Your competitive edge probably needs to come from somewhere else, like deeper company-specific analysis.
Okay, so if broad macroeconomics is tricky and unlikely to offer a consistent edge, what about specific, perhaps more localized or overlooked investment opportunities? The British water privatization example from the book is interesting here. How did that situation present an opportunity, and what was the author's insight that allowed him to capitalize on it?
The British water industry privatization back in the late 1980s presents a really fascinating case study in finding value where others see problems. 10 regional water and sewage companies were initially sold off by the government as a bundle. They were packaged and priced specifically to move quickly into public hands. They had attractive dividend yields, which were presumed to rise with inflation, providing some protection. And the British government even injected what the book calls a green dowry, basically, a big stack of cash to help pre-fund enormous mandated capital investments needed to meet new environmental standards. That reduced future uncertainty. Best of all, the stocks were offered at really low single-digit price-to-earnings ratios, PEs. Dirt cheap, really. Why so cheap? The bargain prices reflected widespread investor fears about potentially tighter water quality laws in the future and the general political unpopularity of privatizing essential services. Fear created the opportunity. The author initially invested in the bundled shares, then strategically shifted into a select few that had even lower PEs and stronger balance sheets.
His reasoning was that water seemed fundamentally less risky in the average business and offered valuable inflation protection. This really highlights the strategy of finding value in politically but fundamentally sound essential businesses that other investors might be shying away from due to broad, perhaps irrational fears or headline risk. It's about looking for opportunities where the market's perception doesn't align with the underlying economic reality and long-term value.
That makes perfect sense, identifying value where others see only risk or unpopularity. But what about international investing more generally? The book mentions some surprising findings about how GDP growth relates to stock returns globally, and then it goes into that specific, really stark example of Sinoforest in China. What did the author learn about the complexities and hidden risks lurking in global markets?
Well, one of the big surprises of international investing, highlighted by long-term historical data, is that countries with rapid GDP per capita growth are not always the ones with the best real returns to stockholders. It's counterintuitive. Japan and Italy, for instance, had very high per capita GDP growth over much of the 20th century, but only average or even low stock returns, partly due, of course, to the catastrophic effects of wars, but also other factors. This just underscores that there's a lot more to investing outcomes than just headline economic growth numbers. Factors like starting valuation, shareholder rights, capital allocation, and political stability matter hugely. The book actually recommends, perhaps controversially to some, sticking primarily to developed countries with strong rule of law, similar legal systems, and transparent accounting standards, particularly those of the former British Empire for most investors, simply because the risks are lower and the framework is more familiar and reliable. And the Sinoforest example, wow, that is just a brutal warning against investing where the rule of law is weak or opaque, or where accounting is unreliable. Sinoforest stock was an absolute rocket ship between 2002 and 2007. Reported earnings per share more than doubled, fueled by this compelling story that China's growth would lead it to gobble up vast amounts of natural resources, including timber. However, the author couldn't shake these nagging doubts about property rights in China. He noted a Chinese analyst's very pointed question at the time. If China is such a land of opportunity, why is everyone, meaning the wealthy and connected, moving family and capital out? A huge red flag. Then, when key executives started bailing out of their own shares, the author followed suit and sold his position. Smart move. Despite the company continuing to report stellar growth on paper, Sinoforest eventually filed for bankruptcy in Canada in 2012, confirming it was a massive fraud. Vantage Timber assets. This just demonstrates the immense risk of investing where the rule of law is weak or opaque, where contracts might not be enforced, and where social position or political expediency might trump profitability and basic investor rights. It emphasizes that a clear understanding of the legal, cultural, and political context is just as important, maybe even more important, than the financial metrics when investing internationally, especially in emerging markets.
Okay, shifting focus again, part 3 of the book moves into assessing management's honesty and capability. This seems incredibly important, especially after discussing frauds like Sinoforest. The book mentions that skilled managers keep businesses focused on doing something uniquely valuable to customers and apply capital where it will earn the best returns. Makes sense. But it also says scammers do leave clues. What kind of clues should we be looking for? And what's the author's overarching advice on evaluating the people running the companies we invest in?
Right. When it comes to assessing management, the book advises focusing not just on the company's stated business strategy or its market positioning, but on its underlying distinctive character. The crucial insight here is that character, the company's culture, its values, how it treats customers and employees, its attitude towards risk, unlike strategy, doesn't fundamentally change very easily. And that character shapes the company's suitability for new opportunities and how it responds to challenges. This method is not only prudent, the author argues, but also convenient for an analyst. Why? Because the company's fundamental character needs to be assessed really only once. Strategy might change year to year, but character tends to endure.
Can you give an example of a company with a distinctive character that directly led to its success, as highlighted by the author?
Geico is presented as a prime example of a company whose success stemmed directly from its distinctive character. It wasn't just about car insurance. Geico competed fundamentally on price. How? By focusing relentlessly on a specific niche of customers, government employees initially. These individuals were statistically safer drivers, meaning lower claims costs. And they generally didn't need or want certain costly services, like a huge network of agents holding their hands. So Geico's management, being of what the book calls a thrifty character, organized the business differently. They bypassed the expensive sales force and sold insurance directly to customers via mail and phone initially. This inherently lower cost structure allowed them to offer lower prices and gain a significant sustainable competitive edge. Their character drove their strategy and their success. It makes you ask, doesn't it? When you evaluate a company, can you identify its fundamental character? Can you see how that character drives its business model and its competitive advantages, or perhaps its disadvantages?
The book also delves deep into how companies allocate capital, particularly using the tobacco companies like RJR Nabisco as a detailed case study. How does this illustrate both good and bad capital stewardship? And what insights can we gain from their strategic decisions around things like growth, acquisitions, dividends, and buybacks?
Yeah, RJR Nabisco provides a really fascinating, multifaceted illustration of capital allocation decisions and their consequences. In the late 1980s, as foreign markets were opening up, RJR Nabisco vigorously expanded its cigarette export sales. It opened a gigantic, highly efficient new plant to support this growth. But the book explains that for cigarette companies, marketing spending, brand building was often even larger than capital spending on plant and equipment. And it was critical to building that brand loyalty, which is a form of economic goodwill. Think Marlboro Man. Companies like Apple, Nestle, Walt Disney spend billions on marketing, building incredibly valuable brands that allow them pricing power. RJR, however, was in a tougher spot strategically, needing to support many smaller, less dominant brands, while its main competitor, Philip Morris, had the global powerhouse in Marlboro.
And how did that play out in terms of their overall financial health and how they use their cash? The book highlights the concept of free cash flow, which seems absolutely central here.
It absolutely is central. The author puts a huge emphasis on free cash flow analysis. He defines it quite specifically as cash flows from operating activities minus the capital spending needed to maintain and expand the existing business. Excludes acquisitions. This is the cash truly available to the owners after maintaining the business. And he notes that tobacco firms historically reinvested only tiny fractions of their massive cash flows back into the core tobacco business. They were cash cows. For instance, in 2014, Altria, the renamed Philip Morris USA, had over $4.6 billion in operating cash flow, but only $163 million in capital spending. That left a staggering $4.5 billion in free cash flow available to potentially buy other businesses, pay down debt, or return to shareholders via dividends or share buybacks. What do you do with all that cash?
That's a huge amount of cash. So what about their approach to acquisitions and spinoffs? How do they deploy that cash, and what does the book say about the success rate of M&A versus returning capital?
Well, the book notes, rather grimly, that statistically, about 2/3 of corporate acquisitions actually miss their financial targets. They destroy value more often than they create it. Why? because buyers typically pay a premium over the market price and then must improve the acquired company's profits significantly just to justify that premium. It's a high bar. The best odds for successful M&A, the book suggests, involve buying at low valuation multiples, paying low premiums, and combining very similar businesses where real synergies exist. Interestingly, the tobacco companies later reversed almost all of their diversification efforts from earlier decades. They realized they weren't good at running food companies, for example. In 2000, RJR sold Nabisco, the food part, to Philip Morris. And then Philip Morris itself later spun off Kraft Foods. The market reaction was telling. Reynolds, which became a pure-play tobacco company, saw its stock more than quadruple afterward, while the still diversified Philip Morris, before the Kraft spinoff, more than tripled. Both great, but the pure-play did better. Spinoffs, which go against the typical CEO empire-building tendency, are often highlighted in the book as fantastic opportunities for investors because they tend to unlock hidden value and improve focus.
That's a really powerful point about spin-offs often creating value. So what's the bottom line here on identifying superior capital allocation by management?
Superior capital allocation is best indicated, the book argues, by a consistently high and stable return on capital employed, or ROCE. That shows management is effectively deploying capital into high-return projects. Philip Morris's returns, for example, were consistently higher and more stable over decades compared to RJR's. And here's a critical principle. If a company lacks opportunities to reinvest its capital internally at returns that are higher than what investors could likely find elsewhere in the stock market, then it should return that capital to shareholders, either through share buybacks, if the stock is cheap, or dividends. Reynolds' stingy capital return policy back in the 1990s, hoarding cash instead of returning it, was identified as a major factor in its stock's underperformance during that period. It demonstrates that simply piling up cash when there are no good internal uses for it actually hurts shareholder returns. This kind of analysis highlights how discerning investors examine not just the reported profits, but critically how those profits are deployed or returned to the owners. It's about stewardship.
Okay, so understanding a company's character and its capital allocation strategy is clearly vital. But what about the more insidious side? You mentioned earlier that scammers leave clues. What are the specific red flags for spotting bad guys or potential fraud in management? The book offers this fraud triangle concept and several specific indicators to watch out for.
Right, the book provides a really crucial framework for trying to spot potential fraud before it blows up. It's built around the fraud triangle, which has three components: pressure, opportunity, and rationalization. You usually need all three for major fraud to occur. The author quotes the philosopher Hannah Arendt, who observed that most evil is done by people who never make up their minds to be good or evil. It's often situational. So you need to watch for situations where maybe massive stock option grants or hefty performance fees create immense pressure on people to hit targets, maybe cut corners, or try too hard. Pride, too, can be a dominant motive, especially when an audience believes in someone's magical powers, creating pressure to maintain the illusion. Then there needs to be opportunity, often through weak internal controls or inadequate oversight. And finally, rationalization, the story the perpetrator tells themselves to justify their actions. Everyone does it. I'll pay it back later. They deserve it.
And the book is some pretty infamous, high-profile examples of this triangle in action, doesn't it?
Oh, it does. Think of Florian Holm, a former Fidelity analyst who later became, as the book puts it, a newsworthy financial scoundrel. He was described as brilliant but erratic. His financial incentives to misbehave the pressure came years later when he co-founded a hedge fund, charging massive fees, 2% of assets, and 20% of profits. His reported performance was top of the charts, making him incredibly wealthy, creating immense pressure to keep it going. Then there's Bernie Madoff, obviously. Operated the world's largest Ponzi scheme while being a former NACH chairman. He famously claimed it was virtually impossible to violate rules shortly before the whole thing collapsed. Madoff's testimony suggested his fraud stemmed initially from pressure to meet unattainable client expectations and deny failure after a bad trade. He needed to cover losses because clients were used to those impossibly consistent large gains. Incredibly, some investors even suspected something was wrong, but thought they could get out in time. The pressure and rationalization were immense.
That's incredible that even those with suspicions couldn't escape the pull. So it's not just about spotting, obviously, crooked individuals, but understanding the whole ecosystem that can enable deception. Does the book point to other, maybe more subtle red flags beyond just the individual manager?
Absolutely. The ecosystem matters hugely. The book points specifically to auditor red flags. First, potential conflicts of interest. The example given is Waste Management, which paid its auditor, the now defunct Arthur Andersen, more than twice as much for consulting services as for the audit itself. and Anderson apparently helped conceal improprieties. That's a massive conflict. Similarly, Enron paid Anderson $27 million for consulting and $25 million for auditing, leading to suspicion, the book notes, that the large audit fees were effectively hush money to look the other way. Second, watch out for tiny, unknown audit firms. Opportunity for fraud arises from lapses in controls, and the auditor is supposed to be a key control. But auditors are paid by the very company they evaluate. While big-name firms can clearly fail spectacularly, like Arthur Andersen with Enron, a huge red flag is when a large, complex company uses a tiny, obscure audit firm. Madoff's Freeling and Horowitz, for example, reportedly had just one working accountant and hadn't conducted proper audits in 15 years. That's opportunity knocking loudly.
So if the auditors aren't doing their job properly or have conflicts, what about the businesses themselves? Are there structural red flags the book highlights that should make investors wary?
Yes, definitely. The book warns specifically about glamorous roll-ups. These are companies that grow incredibly fast, often in hot industries, primarily through acquisitions. Fast-growing industries tend to suck in capital, creating opportunities for hype and sometimes impropriety. And the constant mergers and acquisitions activity confuses the numbers, making underlying performance hard to track. It's noted that the largest accounting scams in recent history, think Enron, HealthSouth, West, WorldCom, Tyco, Sunbeam, almost all involved rolling up scores of other companies. A key warning sign was their heavy reliance on adjusted earnings figures, which were often much more flattering than the standard GAAP figures reported in official filings like the 10K. Another structural red flag mentioned is the use of tax havens and homeless companies. While incorporating in a low-tax jurisdiction like Ireland isn't illegal in itself, the book warns about forum shopping companies deliberately seeking out jurisdictions with the most lenient rules or weakest enforcement. And if managers physically relocate themselves to tax havens that lack extradition treaties with your home country, there's effectively no legal recourse for investors if fraud does occur. That's a major governance risk.
Okay, so given all these potential pitfalls, bad actors, conflicted auditors, misleading structures, how does the author suggest we try to avoid being hoodwinked? What's the overall avoidance strategy?
The overall avoidance strategy suggested is pretty straightforward, if perhaps requiring discipline. To avoid being hoodwinked, you might miss some of those spectacular moonshots like Enron's initial stock surge before it crashed. But the author makes it clear he prefers to avoid even a small chance of quick, devastating losses. Preservation of capital is key, so his filters are. He stops immediately if a manager has a known criminal record or acts as if they're above the law. Basic character check. He avoids glamorous hype stocks, especially those that seem chronically overpriced and are constantly raising more capital through stock offerings. That can be a sign the underlying business isn't self-funding. And he avoids overly complex corporate structures, especially those involving lots of offshore entities or confusing accounting. The key idea is to slash the possibility of disastrous, catastrophic outcomes without significantly reducing your overall opportunity set. Because, the book argues, plenty of good, understandable, well-managed opportunities exist even without taking these extreme, opaque risks.
All right, let's move into Chapter 18, which dives into which earnings number. This highlights that while earnings ultimately determine value over time, there are just so many different definitions of earnings. It uses that old joke, how much does this add up to? Well, what would you like it to add up to? Why is understanding the right earnings number so crucial? And what does the book suggest is the most reliable measure for an investor focused on true value?
Understanding the right earnings number is absolutely paramount because, as the joke implies, radically dissimilar estimates of a company's value can come from using different definitions of earnings. This allows for significant manipulation or, at best, misunderstanding. Many investors and much of the financial media fixate on those quarterly earnings snapshots. Did they beat the estimate by a penny? But the author prefers viewing earnings as a moving picture, a continuous flow of past and, more importantly, future cash flows. It's about the underlying economic engine. From an owner's standpoint, what you really care about are quality earnings. And the book defines quality earnings as corresponding closely to the free cash flows that could safely be paid out as dividends to the owners without harming the business's long-term health. Now, analysts and companies themselves frequently adjust reported GAAP results in countless ways to produce higher adjusted or pro forma non-GAAP results. They might add back stock compensation, restructuring costs, amortization of intangibles. While some of these adjusted measures, like EBITDA, earnings before interest, taxes, depreciation, and amortization, can be useful in specific contexts, like comparing companies with different debt levels or tax rates. The author finds that standard GAAP earnings, owner earnings, concept popularized by Buffett, and particularly free cash flow, are generally the clearest and most reliable indicators of a company's true underlying value generation. So it makes you wonder, when you look at a company's results, are you focusing on the headline-adjusted number, the static snapshot, or are you digging deeper into the moving picture revealed by the cash flow statement?
That focus on the moving picture of cash flow makes a lot of sense. The cash flow statement is often neglected, isn't it? People focus on the income statement's bottom line. But what does the cash flow statement truly reveal about a business that reported earnings might hide? And why is that distinction so critically important?
You're right. The cash flow statement is indeed often neglected, maybe because it seems more complicated. Yet it's absolutely indispensable because it deals with actual cold, hard cash moving in and out, not just accounting entries or accruals. Reality versus paper. It starts with operating cash flow, which is a measure of the net cash receipts generated by the core business operations. This is the cash available to sustain the business, to expand it, or potentially to be returned to the owners. The subsequent investing and financing sections then track exactly how that operating cash was actually used, reinvested in the business, used for acquisitions, paying down debt, buying back stock, paying dividends. Critically, as the book points out, capital spending, CapEx, that merely sustains the existing business, just replacing worn-out equipment, often called maintenance CapEx, is frequently lumped together in financial reports with capital spending that genuinely expands the business, expansion or growth CapEx. An analyst must try to separate these two. It's crucial. Why? Because companies in dying industries might slash or eliminate sustaining CapEx to artificially boost reported free cash flow in the short term, basically extracting cash by letting the business wither away. But this is obviously unsustainable. The bottom line is, unless the accounting numbers of the reported earnings more or less reflect the underlying economic reality revealed by the cash flow statement, then none of our estimates of intrinsic value are going to be reliable. The cash flow statement provides that unvarnished economic reality check.
The book specifically warns that standard GAAP accounting, despite its rules and intentions, often struggles with accurately reflecting reality in three specific areas: inflation, intangibles, and roll-ups. It says these can make it harder to get a true picture of earnings. Can you expand on those three areas and explain why they present such challenges for investors relying on reported earnings?
Yes. These three areas are highlighted as significant potential blind spots or distortions within GAAP accounting, complicating the true assessment of sustainable earnings power. First, rapid inflation. During periods of high inflation, GAAP generally relies on historical costs for assets like inventory and property. These historical costs can become dramatically mismatched with current inflated selling prices, often leading to an overstatement of true economic profits. Costs are understated relative to revenues. Second, intellectual property or intangibles. Think R&D spending. Under GAAP, R&D is typically written off as an expense when it's incurred, leaving little or no trace on the balance sheet, even if that spending produces immensely valuable discoveries, patents, or brands years later. The asset value isn't properly captured. For acquired intangibles through M&A, the accounting gets even murkier, especially with goodwill. And third, serial acquirers or roll-ups. As we discussed, companies that constantly engage in mergers and acquisitions create this cloud of dust that just muddies the analysis of underlying operating trends. Their financials become incredibly complex, making it difficult to discern organic growth from acquired growth or true profitability from accounting maneuvers. It often obscures a lack of fundamental performance in the core business. So this makes you wonder, how deeply are you scrutinizing the nuances of accounting, especially in these three potentially problematic areas, to ensure you're not accepting reported or adjusted numbers at face value without understanding the underlying economics?
And Valiant Pharmaceuticals seems to be the poster child for this adjusted earnings issue, doesn't it? Where their own self-defined metrics painted a far, far rosier picture than the cash flow reality. What exactly happened there, and what was the critical disconnect?
Valiant is a truly stark cautionary tale about the dangers of relying on heavily adjusted non-GAAP earnings. Its self-defined cash earnings metric was indeed a superb indicator of its stock performance for years. The share price surged dramatically, from around $7 in 2008 to over $263 in 2015. It looked like magic. The author, however, looking deeper, found Valiant's definition of cash earnings to be far too generous. Dangerously so. Why? Because Valiant's actual GAAP operating cash flows were persistently and significantly lower than its reported cash earnings, often by half. There was a huge gap. This was because Valiant's definition conveniently ignored some real operating costs that actually used cash. It wasn't true cash available to owners. The author specifically feared that both Valiant's deal frenzy, its aggressive debt-fueled acquisition strategy, and its controversial strategy of rapid product price increases on acquired drugs were contributing to growth in a completely unsustainable way. For example, the book notes that in February 2015, Fallon hiked the prices of 2 acquired heart medications by an astonishing 525% and 212% respectively, overnight. This later attracted intense political scrutiny, with presidential candidates calling for investigations into drug price gouging, specifically citing Valentin. The former CEO even testified later that some price increases were mistakes. So this is where it gets really interesting for investors. A profound disconnect between reported, highly adjusted cash earnings and actual GAAP-defined operating cash flow can be a massive red flag. It often signals an unsustainable business model, no matter how exciting the stock performance appears in the short term. Follow the real cash.
So the warning is crystal clear. Be wary of adjusted earnings. Don't take them at face value. Beyond that, what else should investors check to ensure they're dealing with reliable financial reporting? And how does all this apply when trying to assess present value and forecast the future?
Well, the core advice is to rigorously check those cash flow statements. Do they tell the same story as the reported earnings? Or is there a big divergence? If so, why? Watch out for large and growing intangible assets on the balance sheet, especially goodwill, particularly in companies that are serial acquirers or real-ups. That goodwill might represent real value, or it might just represent having overpaid for acquisitions. While determining sustaining costs in traditional manufacturing might be relatively straightforward, the book notes that for businesses built on brands, intellectual property, or regulated monopolies, the costs of renewal are often indefinite and harder to pin down, making true owner earnings more difficult to estimate accurately. Discrepancies between reported earnings and true owner earnings can also signal underlying operational issues that might show up in cash flow first, like rapidly rising inventories or accounts receivable. Are they struggling to sell products or collect cash? Now, regarding assessing present value and forecasting, this is where the uncertainty really bites. The book stresses the need to classify your assumptions by their believability. Forecasts over the next couple of years might be reasonably reliable for stable businesses, but predictions stretching 20 years out. The book calls that sheer fantasy, especially for rapidly changing technology stocks. Yet standard present value math, like discounted cash flow models, often dangerously treats all those numbers, near-term credible forecasts, and long-term fantasy projections as equally legitimate inputs. It mixes credible information with pure conjecture. The math itself is easy. Anyone can run a spreadsheet. What's incredibly tough is knowing whether your underlying assumptions about long-term growth rates, margins, and discount rates are actually reasonable and achievable. While value investors are instinctively wary of overpaying based on rosy forecasts, academic finance theory often assumes perfect information and appropriate pricing, a stark contrast to the messy, uncertain reality investors face. So it makes you wonder, are your valuation models grounded in realistic, credible assumptions, or are you inadvertently mixing solid data with a large dose of wishful thinking about the distant future?
The discussion around corporate lifespan and industry certainty is also fascinating. It's not just about a company's current numbers, but its fundamental ability to endure over decades. What attributes tend to signal longevity and sustainable profitability? And how can we identify industries that possess a durable, competitive moat?
Right, corporate lifespan and the certainty of future profits aren't things you can easily measure numerically from a financial statement. So we have to rely more on subjective, qualitative indicators. Industries themselves change constantly, so focusing on the underlying attributes and circumstances of industries, rather than just specific ones that are hot today, is often more useful in spotting potential long-term winners. What makes an industry structurally attractive? The railroads example is really counterintuitive but illustrative. Intuitively, you'd think railroads should have been decimated by trucks, planes, cars. Passenger trains were essentially nationalized in the U.S. in 1971. Yet freight railroads have managed to protect their profit margins surprisingly well. Why? Because they often function as local monopolies or duopolies. Once tracks are laid in a specific corridor, building a competing railroad right alongside is rarely profitable. That high fixed cost creates a barrier. Air, truck, and shipping lines face much more direct competition on identical routes. So railroads have a structural moat. The taxi medallions example in New York City also illustrates how regulation can create artificial certainty and generate economic rents for decades, until that regulation is disrupted by a new business model like Uber and Lyft, showing that even regulatory moats aren't always permanent. The book also refers to a study of golden geese of profitability over 50 years. These were companies identified in 1965 with consistently high operating profit margins, over 20%. They were concentrated in industries like pharmaceuticals, railroads, branded consumer products, and some mining, suggesting these industries possess some kind of durable, industry-wide competitive moat that allowed superior profitability over long periods.
Okay, so some industries have structural advantages, but what about those explosive growth industries like technology? The book talks about photo-finished industries using Eastman Kodak, once a dominant tech giant, as a prime example. What lessons can we draw from its eventual demise?
Eastman Kodak is a classic, sobering example. It was once a glamorous growth stock with spectacular profit margins, especially on its Kodachrome film, a true blue chip. But ultimately, its core business, chemical photography, was completely disrupted and eventually killed by digital imaging, a technology Kodak itself had pioneered but failed to capitalize on effectively. Polaroid also went bankrupt. Explosive growth and fabulous profitability, the book warns, attract traders and competitors like moths to a flame. But rock stars are not known for long lifespans or predictability. High growth is hard to sustain. Xerox, IBM, and Eastman Kodak were all darlings of the Nifty 50 growth stock era in the early 70s. IBM ultimately fared best because it managed to completely reinvent its business, shifting from hardware to software and services over decades. Xerox diversified somewhat but saw margins collapse in its core copier business. Kodak, still largely focused on film and cameras, went bankrupt. This raises a really important question for your investments. Does your thesis rely on a company staying static and dominant in a dynamic, changing industry? Or does it depend on the company's proven ability to adapt, innovate, and transform itself? Because the history of technology clearly shows that invention alone isn't enough.
No.
Continuous innovation and successful adaptation are absolutely key to long-term survival and success.
And what about those unexpected consequences that even brilliant engineers might overlook? The book uses the example of asbestos. It's a sobering reminder that a technology's intended purpose isn't the whole story, right? There can be unforeseen side effects.
Exactly. Engineers, and often company management, tend to focus primarily on a technology's intended purpose and its immediate benefits. They might not fully consider or might downplay potential long-term side effects or broader societal consequences. Asbestos, despite being hailed as a miracle mineral for its fire retardancy and insulation properties, led to devastating health consequences and waves of lawsuits that eventually bankrupted major companies like Harbison Walker. The public ultimately rejected asbestos due to its severe indirect effects on health, not because it didn't work as a fire retardant. Functionality wasn't the issue, the externality was. The book mentions historical warnings and evolving public opinion about products like tobacco, alcohol, and nuclear energy, and asks, quite pointedly, if this hints at potential future rejections of currently accepted products or technologies. Think about plastics, fossil fuels, maybe certain aspects of social media or genetic engineering. Opinions evolve. This really encourages you, as an investor, to consider the broader societal implications and potential negative externalities of the businesses you invest in. These factors can significantly impact a company's long-term viability and social license to operate, even if its core product is functionally sound and currently profitable.
And finally, within this section on understanding businesses, what about the idea of winner-take-all lottery stocks from Chapter 15? It sounds like a very tempting yet potentially deceptive scenario for investors chasing the next big thing.
Yeah, Chapter 15 vividly describes these winner-take-all lottery stocks industries with a really stark statistical breakdown. The scenario is, out of maybe 100 firms starting in a new industry, one becomes a massive 100-fold winner, maybe another becomes a 50-fold leader. But perhaps 50 others just stagnate or tread water, and the remaining 48 go bust completely. The overall basket of all those stocks, despite the huge winners, might only double in value over a decade or two, which the book deems mediocre overall performance. The winners barely compensate for all the losers. The hard disk drive HDD industry is presented as a perfect example. The book notes over 200 firms cumulatively tried their hand at making HDDs over the decades, but today the industry is dominated by just two giants, Seagate and Western Digital. Winner take most. Seagate stock did surge 100-fold at one point, a massive win. But the book reveals that the real reason for its outstanding performance wasn't just its disk drive operations. It was actually a shrewd side bet the company made in software, which it later sold to Veritas, a data storage software company, for Veritas stock worth a staggering $17 billion around the time Seagate went private. Effectively, the private equity firm that bought Seagate paid under $2 billion for the core disk drive operations themselves, a fantastic bargain made possible by that software windfall. This just highlights that even in a seemingly winning, consolidating industry, picking the individual winners in advance is incredibly hard. And sometimes the true success comes from unexpected places, like a savvy side investment or shrewd financial maneuvering like a spinoff, rather than just from the core business's apparent growth trajectory.
This reminds me so much of that famous story about Xerox inventing groundbreaking technologies at its PR research center, the graphical user interface, the mouse, Ethernet, but then famously failing to capitalize on them. They let Apple, Microsoft, and Hewlett-Packard build behemoths around ideas that originated within Xerox itself. It perfectly illustrates that innovation isn't enough without execution and commercialization.
It's exactly right. Xerox notoriously failed to turn these world-changing inventions into market dominance, allowing others to swoop in and profit immensely. There's that famous, maybe apocryphal story of Bill Gates retorting to Steve Jobs after Jobs accused Microsoft of stealing Apple's ideas, which Apple had largely taken from Xerox PARC. Well, Steve, I think there's more than one way of looking at it. I think it's more like we both had this rich neighbor named Xerox, and I broke in to steal his TV set and found out that you had already stolen it. Whether true or not, it perfectly illustrates that invention alone isn't sufficient. Successful commercialization, having the right strategy, the right timing, and relentless execution are absolutely key to turning groundbreaking ideas into sustainable market dominance and shareholder value. Xerox had the inventions but lacked the vision or execution to build businesses around them.
And this leads us nicely to the broader topic discussed later in the book about rolling over, meaning how competitive moats and brand goodwill can erode over time. What does the book warn about concerning these intangible assets, especially in the context of those roll-ups or perhaps asset-heavy industries?
Right, the book emphasizes that while strong competitive moats and powerful brands can be incredibly valuable, long-term intangible assets, generating superior returns for decades, without them, the goodwill that appears on a balance sheet after an acquisition is often highly perishable. It can vanish quickly. The most worrisome cases, the book warns again, are those roll-ups companies constantly on debt-funded buying sprees, acquiring mediocre businesses at high prices. In the frenzy to do deals, buyers often have less time to truly get to know the acquired management teams and the underlying quality of the businesses they're buying. This makes it hard to be fussy about paying a fair price or ensuring there's a real competitive moat. So, that goodwill recorded on the balance sheet can represent genuine, durable, intangible assets like brands or patents. Or, equally likely, can simply represent having paid too much for the acquired company. Overpayment, basically. And here's the critical point the book makes. The accountants won't tell you the difference. GAAP accounting for goodwill is complex and doesn't easily distinguish between true economic value and mere overpayment. So investors themselves must figure it out by analyzing the underlying business quality and the price paid.
Wow, it really highlights that even seemingly safe industries can become disaster zones when management strays from core principles, overpays for acquisitions, or takes on too much risk, especially financial risk. It sounds like the book is advocating for a very conservative, almost boring approach to capital structure, particularly in certain types of industries, right?
It definitely leans that way, especially for certain industries. The book warns about having no fear of flying in asset-heavy industries. Think real estate, energy exploration, utilities, airlines, and finance. These industries often attract lenders easily because they have seemingly ample collateral buildings, oil reserves, planes, loan books. But their return on equity can actually be pretty lackluster without using significant financial leverage, borrowing heavily. They are also inherently cyclical, and perceptions of risk within these sectors tend to swing wildly. Often, the book notes, success in these tough industries requires really superb capital allocation, including having the discipline and financial strength to invest heavily when competitors are struggling and pulling back, buying assets cheap, and maybe pulling back when everyone else is euphoric. That's very hard to do. The GMA example, General Motors financing arm, is instructive here. When GM fully owned GMA, it essentially had a financial company's balance sheet embedded within an industrial company, with massive borrowing supported by relatively thin equity. GMA failed the two matching rules for financial companies: don't fund risky assets with risk-averse funding and match asset liability durations. It plunged into subprime mortgages and extended credit to dodgier automotive customers. When the crisis hit, GM shareholders lost everything in the subsequent government bailout. Leverage killed them.
So when thinking about corporate lifespan and the dangers of leverage, particularly in cyclical or asset-heavy businesses, what's the author's ultimate preference? What kind of capital structure should investors favor?
For cyclical businesses especially, the book argues there's a fundamental trade-off between maximizing current profits, often through leverage, and ensuring corporate longevity and resilience. High debt makes businesses incredibly vulnerable during downturns, especially if their assets can't be easily converted to cash or repurposed for another industry. Think of specialized manufacturing equipment, or maybe an airline's planes during a travel ban. So the author clearly states his preference for businesses that demonstrate appealing growth and profitability without relying heavily on financial leverage. He wants businesses that are inherently strong, not just juiced up with debt. He interestingly points out that historically, about half of listed Japanese stocks carried more cash than debt on their balance sheets. Their corporate philosophy often views businesses as communities of people that adapt and endure, keeping a distinctive character and mission, sometimes prioritizing stability over maximizing short-term returns. He also notes that companies with significant controlling shareholders, including families, tend to outperform over time, perhaps because they have a longer-term orientation and less pressure for quarterly results. For investors seeking long-term success, the book suggests that Nirvana is a profitable, growing enterprise that is certain to endure. Seems obvious, but hard to find. Since leverage creates vulnerability, investors should look for businesses that respect basic financial matching principles. Fund safe assets with safe borrowings, and fund long-term assets with long-term debt or equity. Match durations. Businesses that are susceptible to commodity cycles, technological obsolescence, or rapidly shifting consumer preferences should tread lightly with debt. Be conservative. Having a strong cash cushion on the balance sheet and access to undrawn credit lines also significantly helps companies weather economic storms and perhaps even take advantage of opportunities when competitors are distressed. Resilience matters.
Okay, let's move into Chapter 17, which focuses squarely on returns. It starts with a really important statement. Returns on stocks depend critically on the price paid, but as time passes, they look more like the returns of the underlying business. Okay, how does this fundamental idea play into the concept of reinvested profits and the critical importance of a company having a competitive moat?
Yes, that statement is really a core tenet of long-term fundamental investing. It bridges valuation and business quality. A dollar of profits that a company retains and reinvests back into the business for growth can be worth much more than a dollar to the shareholder, if it's invested wisely. But it can also be worth less than a dollar if it's squandered on poor projects or overpriced acquisitions. For companies that possess skillful, honest management, that offer something unique to customers, and operate in resilient industries with barriers to entry, in other words, companies with a durable competitive moat, those reinvested profits nearly always improve the shareholder's ultimate rate of return significantly, often well beyond the initial earnings yield calculated at the time of purchase. This is the power of compounding within a great business. This really is the source of that famous maxim, often attributed to Buffett, that time is the friend of the good business and the enemy of the bad one. Compounding works for you in good businesses and against you in bad ones. So as an investor, you need to actively look for that moat or competitive barrier, be it brand, network effects, low costs, switching costs, regulation, to ensure that a good business today will likely stay good tomorrow and continue compounding value over time. Typically, the book notes stocks that appear cheapest based on current earnings yield those with very low PE ratios often suffer from at least one significant defect. Maybe they're in a highly cyclical or commoditized industry with no pricing power, or perhaps there are concerns about dubious accounting practices. That seemingly high yield might be deceptive or unsustainable. You have to look beyond the headline number.
The book presents some pretty compelling historical data supporting the low PE effect, essentially suggesting that buying chipper stocks, on average, tends to yield better returns over time. Can you explain this phenomenon and how it's supported by the data presented?
Yes, the low PE effect, sometimes called the value effect, is closely linked to the small cap stock effect, as many low PE stocks are smaller companies. The book presents data, Table 17.1 in the source, showing cumulative annualized returns sorted by earnings to price, EP decile. Remember, EP is simply the inverse of PE, so a high EP means a low PE, or a cheap stock based on current earnings. The data compares results using both value weighting, where returns are proportionate to each company's market value, and equal weighting, where equal amounts are invested in each company. It shows that most stocks with extremely high earnings yields, very low PEs, are indeed small caps. And the equal-weighted high earnings yield portfolio visibly outperforms the value-weighted portfolio, suggesting the effect is stronger among those more obscure, smaller shares. But even the value-weighted high earnings yield portfolios focusing on cheaper stocks among larger companies still vastly outperform the market averages over the long period studied. The trend is very clear in the data.
For both weighting methods, the cheaper deciles nearly always return more, often significantly more, than the more expensive deciles over long time horizons. This is a very clear and robust empirical finding from decades of market history. On average, buying cheaper stocks, despite their potential perceived defects, has historically performed better over the long term. Valuation matters.
Walmart back in 1999 is given as an example of the opposite, a fantastic company, no doubt, but trading as an expensive growth stock with a PE ratio of 55. How does the author suggest investors tie together the expected growth rate and the current earnings yield for these fast-growing, highly valued companies to determine if their lofty price is actually justified?
All right, Walmart in 1999 is a great case study. Fantastic business, dominant retailer. But at a PE of 55, its stock had a tiny earnings yield of only 1.8%, which is just 1 divided by 55. Investors buying at that price were clearly not buying it for the current earnings. They were counting heavily on very high future returns on equity or extremely rapid future earnings growth for many years to come. For these kinds of fast-growing high PE stocks, the author proposes a practical method. Try to explicitly tie together the assumed future growth rate with a target future earnings yield. He calculates how many years of a specific assumed growth rate it would take for the company's earnings per share to grow enough to reach a more reasonable target earnings yield, say 8%, which implies a PE of 12.5. For Walmart in 1999, that would have required its EPS to grow from $1.25 to $5.53. In the best case scenario for these growth stocks, this crossover point to a reasonable valuation isn't too many years away, and the enterprise is still growing dynamically when that more reasonable valuation is finally attained.
This provides a practical, quantitative way to assess whether a high-flying growth stock's current price is genuinely justified by its plausible future prospects, helping you avoid overpaying for growth that might not materialize or might already be more than fully priced in by the market. It forces you to be explicit about your growth assumptions.
The book then uses data on median PEs for the 3,000 largest stocks over time to show the power of compounding, specifically for investing when valuations are generally low versus when they're high. It provides a clear long-term pattern for investors. What does this broader market valuation data reveal about subsequent long-term returns?
Yes, examining the median PEs across the market provides another compelling long-term perspective on valuation. Looking at the median PE ratios for the 3,000 largest U.S. stocks from 1962 all the way to June 2016, the data reveals a striking pattern. Markets where the median stock had a PE of less than 15 subsequently returned an average cumulative 317% over the following 10 years. Buying when the market was generally cheap paid off handsomely. In stark contrast, markets where the median stock had a PE greater than 25 subsequently returned just 65% cumulatively over the following 10 years. Buying when the market was generally expensive led to much lower future returns. This clearly shows the immense power of compounding working in your favor when you buy at lower valuations and working against you when you buy at higher valuations. And it shows that the starting valuation level was still significantly impacting returns a full decade later. This is just a very clear, long-term historical pattern for you to consider. Buying into markets or individual stocks when they are cheaper, on average, provides a significant tailwind for future returns over long periods.
It reinforces the idea that the price you pay matters immensely, not just for individual stocks, but for the market as a whole.
How do stocks, bonds, and treasury bills theoretically and historically interact in this context of returns and valuation? Should their yields move together? And what does the historical record tell us about trying to use these relationships for market timing?
Well, theoretically, stock earnings yields, the inverse of PE ratios, should, over the long run, move somewhat in tandem with the yields available on bonds and treasury bills. They are competing investments after all. If bond yields are very high, investors should demand a higher earnings yield, lower PE, from stocks to compensate for their extra risk, and vice versa. However, the actual historical record shows long periods, regimes as the book calls them, where these relationships diverge significantly, along with eventual mean reverting tendencies. It's not a neat, predictable dance. For example, before 1959, stocks almost always offered higher dividend yields than bonds did. Investors demanded that extra yield for taking equity risk. Then, despite the trauma of the Great Depression and World Wars leading many to believe stocks were inherently dangerous, the 1940s saw incredibly low bond rates. Theoretically, that should have justified very high stock prices, low earnings yields. But PEs were actually quite moderate at the time, making it, in hindsight, a fabulous moment to buy stocks. The market was cheap relative to bonds. Later, through the 80s, 90s, and right up until the global financial crisis, bond yields remained stubbornly at a premium to broad stock market earnings yields, like the Shiller cyclically adjusted PE yield. Stocks looked expensive relative to bonds for a long time. By the tech bubble peak in 2000, the Shiller earnings yield was never lower, and the shortfall compared to bond yields was never wider, a clear warning sign against equities at that time. Sometimes, as the author rightly notes, mean reversion just takes too long for market timers to profit from these apparent misalignments. This history highlights that while theoretical relationships exist, real-world markets can diverge from perceived norms for very extended periods. making perfect market timing based on these relationships incredibly difficult, if not impossible. It underscores the need for a long-term perspective and, as the book says, the readiness for absolutely anything to happen in the markets.
That concept of the uncertainty bridge really sums up the difficulty of perfectly predicting the future in investing, bridging today's known yield to tomorrow's unknown return.
Yeah.
How does the book ultimately suggest investors navigate this inherent uncertainty between current valuation, like earnings yield, and future expected return?
Right. The book emphasizes there's just no tidy, reliable formula to perfectly bridge today's earnings yield to tomorrow's total return, precisely because too many crucial factors are uncertain. Glamour stocks, for instance, high PE growth stocks, can work spectacularly well, but only as long as their growth momentum continues to outstrip the gravitational pull of mean reversion in their valuation multiples. Eventually, growth slows or valuation contracts. The author describes his personal approach as generally buying stocks with high current earnings yields, low PEs, hoping for some valuation lift from mean reversion, and accepting that slower growth might reduce returns somewhat. But only as long as the underlying business doesn't go splat, meaning it doesn't face existential threats and it consistently generates cash that management doesn't fritter away foolishly. For a truly longer-term investor, many risks and uncertainties, especially those big macro and industry-level shifts, are best considered simply as eventualities with unknown timing. You know they might happen, but you don't know when. Think about pandemics, wars, technological disruptions.
Therefore, you need to build a portfolio and an investment approach that is robust enough to be ready for absolutely anything, rather than relying on precise forecasts or assuming the future will look just like the recent past. This means focusing on business quality, durable moats, strong balance sheets, honest management, and paying a reasonable price factors that offer resilience regardless of unpredictable future events.
The book continually emphasizes the importance of invest in what you know, linking it directly to defining and staying within your personal circle of competence. How does this concept apply differently to individual stock picking versus, say, choosing to invest in a broad market index? And what classic example does the book provide to illustrate this?
Defining and respecting your circle of competence is presented as absolutely paramount because it helps keep your investments safe from fundamental misunderstanding, which is a major source of errors. For picking individual stocks, staying within your circle means you need to be able to identify the key factors that will determine that specific company's income years out, and you need to understand, with reasonable confidence, how those factors interact. It requires deep, specific knowledge. For an index investor, the book suggests the factors within their circle of competence become more macroeconomic, but perhaps simpler to grasp. They need to understand the general cyclicality of corporate profit margins, have a realistic assessment of the overall economy's long-term growth rate, which the book notes is often overstated due to dilution from stock options, or the constant emergence of new, unindexed startups like Google, Facebook, Uber were initially, and have a sense of what constitutes a reasonable discount rate or overall market valuation level. The book implies, perhaps optimistically, that if you've read this far into its detailed analysis, you are likely financially literate enough to include the S&P 500 index within your circle of competence. You can understand the broad dynamics of the main market index. The Washington Post example involving Warren Buffett is used as a classic illustration of staying firmly within one's circle of competence. Buffett understood the newspaper business intimately. He knew the Washington Post subscription revenues were highly predictable. Its ad sales were cyclical, but on a clear upward trend due to a growing DC population and its dominant market position. As the leading newspaper, it naturally attracted advertisers and could afford a superior newsroom, creating a virtuous cycle and a strong moat. Buffett didn't need, as the book says, a 3,000-line spreadsheet to understand its value. The business logic was clear and well within his established circle of competence.
The book also touches on corporate governance and uses Berkshire Hathaway's unique approach to managing its portfolio of wholly owned companies as an example. What does this tell us about the importance of management incentives, oversight, and maybe even corporate structure?
Right, the topic of corporate governance, how companies are run and overseen for the benefit of shareholders, has become increasingly important to investors in recent years. For instance, the book mentions Japanese companies that historically piled up huge amounts of cash on their balance sheets without reinvesting it effectively or paying it out as dividends. This was seen by many governance advocates as serving interests other than those of the owners, perhaps prioritizing stability or management perks over shareholder returns. Activists have pushed for change there. Generally, S&P 500 companies in the U.S. are held to relatively high standards of governance and transparency, and their dominant positions often suggest a history of reasonably good management, though obviously with exceptions. Niche companies might have more distinctive offerings, but the capital allocation advantage often goes to the giants with deeper pockets and broader reach. However, being constantly in the public spotlight, as large companies are, can also create pressure to manage earnings or manipulate numbers to meet quarterly expectations. Think Enron or Valeant again. But combined with strong transparency requirements and independent oversight, that same spotlight can also act as a powerful disinfectant discouraging bad behavior. Berkshire Hathaway's style is presented as quite distinctive, almost countercultural in today's world of hyperactive management. Berkshire typically acquires well-positioned, well-managed companies outright and then encourages their existing managers to just keep doing what they do well, but with a very light touch from headquarters. Reportedly only about 20-25 staff at HQ overseeing hundreds of thousands of employees worldwide. They don't seek detailed budgets or impose complex reporting structures. Instead, Buffett instructs his managers simply to widen the moat, build enduring competitive advantage, delight your customers, and relentlessly fight costs. Keep it focused on the long term. Buffett famously identifies his ABC enemies for managers as arrogance, bureaucracy, and complacency, things that destroy businesses over time. The whole intent of this decentralized structure is to avoid the short-term pressures and bureaucratic temptations that often lead to poor capital allocation decisions or even outright fraud in more traditionally managed conglomerates. The key takeaway for you, the listener, is powerful. Don't invest unless you believe the right incentives are in place for management to act like owners. And management owning a significant amount of stock alongside you is generally a very good sign that their interests are likely aligned with yours.
Finally, the chapter titled Avoid Competition and Obsolescence really ties many of these themes together. It emphasizes that no one sets out to invest in a dying, commoditized, debt-laden industry, but that's how many investing stories end anyway. How does the structure of the S&P 500 itself offer some protection against this? And what final lessons can we learn from companies or industries that failed to adapt or faced irreversible economic shifts like those impacted by offshoring?
That's right. The sobering thought that no one intentionally invests in obsolescence, but it happens all the time because industries change, competition intensifies, and technologies disrupt. The S&P 500 index, the book points out, always contains both declining businesses, think maybe some traditional retailers or media companies today, and sparkly and new growth stocks. It's a mix. Well, the average lifespan of a company in the S&P 500 has indeed shortened significantly over the decades, from maybe 60 years historically down to perhaps 16 years now, partly due to increased M&A activity. The index's market cap weighting provides a crucial built-in defense mechanism. It constantly automatically rebalances towards the winners, whose market caps grow, and away from the losers, whose market caps shrink. So as the book puts it, simply being average by owning the index protects you from the full ravages experienced by investors concentrated in the declining companies at the extremes. The index adapts even if individual companies don't. The book also touches on the impact of trade deficits and offshoring. It argues that the long-standing U.S. policy of tolerating massive trade deficits effectively doomed many domestic manufacturing businesses that lacked a strong brand and produced goods that could be made cheaper offshore. Examples given include suit linings and Dexter shoes, a former Berkshire holding that went bankrupt. Berkshire had better luck with its branded textiles that had more pricing power. For commodity businesses, Buffett eventually favored investing in low-cost producers located in lower-wage nations, like the Korean steel company PSCo. It's about adapting to global economic realities, and it circles back to Buffett's method. He often says he made his fortune by capitalizing on others' daft behavior, market irrationality. He's grateful, he jokes, to finance professors who teach that searching for bargains, market inefficiencies, is pointless. He specifically looks for situations involving an overreaction to a major problem that can be fixed in an otherwise fantastic business. Think American Express during the Salad Oil scandal, or Geico when it nearly went bankrupt. Temporary problems and great franchises. Such an investment, when found, ideally combines all four key elements of value. A high initial earnings yield, because the price is depressed. Good future growth prospects, once the problem is fixed. A strong moat, protecting against permanent failure. And a high degree of certainty about the business's long-term future. His preferred companies feature transparent accounting, where owner earnings closely mirror reported numbers, showing a clear, reliable flow of real cash. Situations like these, offering that perfect combination, don't come around very often. That's what makes them truly special opportunities for you, the patient and discerning investor, to seek out.
Wow, this deep dive into Joel Tillinghast's Big Money Think Small has truly been enlightening, hasn't it? We've covered so much ground, from Tillinghast's unique personal qualities like patience and flexibility to the dangers of overconfidence and complexity, especially with obscure financial products. We've explored the timeless lessons from historical bubbles like the South Sea Company and more recent corporate collapses like AIG, Enron, and Valiant, and really hammered home the critical importance of understanding capital allocation and assessing management's character and incentives.
Absolutely. And the consistent theme, if we try to connect all these dots back to the bigger picture, really seems to be clarity. Clarity in understanding what you truly own, who is managing your capital, and what the genuine economics of the underlying business are, rather than getting lost in market noise, complex narratives, or misleading adjusted earnings figures. The most valuable knowledge, it seems, isn't about trying to predict the future with certainty, because you can't. It's about understanding probabilities, recognizing patterns, focusing on resilience, and being able to spot genuine, durable value where others might see only temporary problems or simply miss the forest for the trees because they're focused on the wrong things.
It really boils down to building a robust framework for your own decision-making, doesn't it? Being emotionally aware, yes, but ultimately letting reason and careful analysis decide your actions, and focusing on those potentially boring, simple, understandable businesses that possess strong character and sustainable competitive advantages, the kind that can endure and compound wealth over the truly long term.
Indeed. And in a world that seems to be getting ever more complex, with constant information overload bombarding us from all sides, this really leaves you, our listener, with a powerful practical question to ponder. How will you define and rigorously stick to your own circle of competence? And what simple businesses will you seek to truly understand, perhaps even master, for the long term?
That's a fantastic thought to leave you with. We really hope this deep dive has given you some valuable tools and insights to help you navigate your own investment journey with more clarity and confidence. Thanks so much for joining us on the deep dive. Until next time, keep digging.